Hey, have you ever felt overwhelmed by the complexity of trading strategies? In fact, you're not alone. So many people have struggled with keeping trading simple. They think it's too confusing and risky. So today I'm here to tell you that it doesn't have to be that way. Stick around as I share some simple trading beginner-friendly strategies that you can implement today to keep it completely simple. So welcome back to the channel where we try to make trading as easy and accessible for everybody. We try to keep it very simple. In this video, I'm going to be breaking down some of those strategies that will help you navigate these markets with complete confidence. Okay, so let's address the elephant in the room. We know how many beginners are daunted by the fact of losing money in the markets. They struggle to get into the markets because of so many different type of trading strategies and the complexities, so many indicators. It gets really confusing. So I want to be breaking it down. I want to show you 3 simple strategies that you can implement today to avoid being stuck in a mess. Keep it simple, keep it effective, and let's make some profit. This is literally has to be one of my favorite trading strategies, whether you want to call it a strategy or you want to call it a consolidation. But I want to explain a little bit about range trading, okay? So usually what you see in a range is something along the lines of this, okay? So you'll have your range, you'll have price action like this, okay? So you'll have consolidation period before either the price breaks down or the price moves higher, okay? So there's a few things that we can look for when we're trading in a range. In order for a confirmed breakout or a breakdown out the range, you need 2 things, okay? So you need large amount of volume and you need price movement, okay? And I'm going to show you an example of this in a minute. But first, I just wanted to explain the concept of range trading. So for example, when we get to the bottom of the range here, you want to see high volume and price to follow that volume. So you can't have one without the other. If you have too much volume, but the price is not moving, that means orders are getting absorbed. Limit longs are absorbing market orders, and it's due for a reversal, okay, rather than breakdown. But if you see volume, if you see price movement, the chances of the range breakout is very, very high. So you can take full advantage of a price breakdown out of the range. You can short it, okay, and take it all the way back down to another range below. So the risk to reward on a trade like this is very, very, very high, okay, because generally when you break out the range, you get massive volume. You can take advantage of big players come in and they've decided that enough is enough. We're taking this down to another range. Okay, so you can take advantage of that. On the other side, on the flip side, if we don't see large amount of volume or price movement, one of the ingredients of a range breakout is missing, we can play the reversal. And the reversal is another high probability, large risk to reward trade for any beginner, anybody watching this video. They can also trade this strategy. It's very, very simple. We get a reversal. We start getting a reversal, okay, we'll get a little retrace. You can enter and look to take the trade. First profits would be the middle of the range, and then you'd be looking to take your full profits at the top of the range. Very, very big, high risk to reward trades, okay? And I want to show you an example of this in real, okay? So here we have a range, okay? So we have a touch at the top and we have a touch at the bottom, okay? Any beginner, anybody watching this video, pay close attention. So as you can see, we have an attempt by the longs to break the range, right? However, what can we see? We can see large volume spike here, but this is the candle into that resistance zone at the top of the range, okay? You want to see this here at the top with a confirmed price movement, okay? That's what I talked about in the last video. You want to see price movement. So we do have a big spike here, okay, which is this candle, if you can see it on your chart, but we don't have the price movement. The price is not following the volume, which means that limit shorts are absorbing this volume. And then as you can see in this part of the price action, the volume fades, okay? This is a prime setup. These are the type of setups that I look for every single day in the markets. This resistance, top of the range, you would enter your short around this area, put your stop losses above the highs of the range. Don't set it really, really close to the top of the range, because the market has a tendency to start searching for stop losses, because the market is designed to look for stop losses. It looks for liquidity. So don't put your stop too tight. You want to set it a few levels above, and then you be targeting firstly the middle of the range. Okay, you can see we've got some touches on the middle of the ranges here. So this is your first target. Okay, and then you would look to fully get out your position at the bottom of the range. Again, look at this. Okay, this is an attempt to break out the range. So we have big volume, that's great, but we have a wick. Okay, big bearish volume, but it's a wick, which means that this volume completely brought back up. Look at the subsequent volume. After that, again, bottom of the range, we don't get the volume, we don't get the price movement, and next day we start reversing trend. Okay, so you could have longed here with a stop loss under the low, take it back up towards the top of the range. Okay, now here is an example of when the price breaks out of the range. Okay, so we get big volume coming in to the range. Okay, then we get subsequent volume. Volume is just still quite large. We're getting movement, and then look at the confirmed breakout. Okay, huge breakout. We saw this, we saw the movement, we saw the close above. Now you can start longing into the breakout. I don't really like breakout trading. Okay, that's not my style, but you can implement this if you're a beginner. Play the trend, start trailing your stop losses. Okay, the trend is going to be higher because we've got a confirmed breakout, so you can start trailing your stop losses until your full profits are realized. So that's your first very beginner friendly strategy that you can implement. Okay, so another favorite strategy of mine is identifying supply and demand zones, as you all are aware. So once we get into a supply zone or a demand zone, I then want to follow the volume. Okay, very simple, very effective strategy that we have on supply and demand zones. Okay, so this was a trade I got into on Friday. Yeah, on Friday. Okay, so let's break it down for you very simply. I put out this alert in our Telegram group, and if you want to be a part of it, link is in the description. Go and join it. It's fantastic. It's free. Great value for money. You will not regret. Okay, but this is a alert that we sent on Friday saying supply zone sitting at 61,850, which was this zone here. Okay, and we were approaching into this supply zone. I want to see low volume and delta as we get into the zone. If not, I will not enter the trade. If I saw a high volume into that supply zone, there would be no trade. However, it means if we didn't see high volume, I'll be taking the trade. We also had a Fibonacci, a golden pocket right into the supply zone. So very high probability to trade. You get this kind of setup, you've got to be able to know how to and when to execute based on volume and delta, but delta we're not going to get into for the purposes of this video. We want to keep it completely simple for the beginner. Okay, so all you need to be following is Fibonacci, supply zone, volume. Okay, that was the three things. Okay, we pulled Fibonacci from the top of this candle to the bottom. That's what gave us a golden pocket ratio, which is the 61.8 and the 66 on the Fibonacci level, which lined up perfectly with the supply zone, making it a very high probability trade. Okay, so the next slide. Okay, this is basically what happened as we approached the supply zone. Okay, this is the move up into the supply zone. We've got a decent amount of bullish volume going into it, but we're still a little bit away from the supply zone. So this type of bullish volume, if you're trying to get through the supply zone, is you want to see it here. You want to see it into the supply zone. Okay, once we're in here, this is when you want to see that bullish volume. If you don't see it, that means buyers are fading. Sellers will step in and defend this zone. It'll be a lot easier for sellers to do that because there's just not enough market buyers at this level. They're either long from the bottom, they've taken profits, or they're long here but there's no other market participants that seem to agree that we can break this level. So volume fades, as we can see. Look at the rest of the candles. This is our entry on this candle, this second bearish candle. We got the first rejection, we got the second rejection, the volume starts fading. Your stop would be above the high, or the high of this, I would say, and then you'd be taking the price down. This subsequently went much further down for us. I got out around this level, but I knew as soon as, this candle here, where all this bullishness was created, I knew as soon as they lost this candle, as soon as the bulls lost this, I knew that we're going to get a free fall at that point, because you now have a lot of bulls, a lot of market orders stuck up here. Okay, so we got a big free fall. So I got out around here. Okay, could have taken it much further down, but I was happy with the profit, so we took it and we got out the trade. You could have actually got in on a retest on this, because as you can see, it's all about identifying support resistance, right? Demand and supply. As you can see here, there's another supply zone. Here, we got rejection here before. Okay, we got price moving into it, but look at the volume, completely faded. And then what we have, boom, rejection. All right, so very, very, very simple. Any beginner, any person trading the markets can go and implement this strategy. This is how we get perfectly executed trades, because we identify our level and then we use volume to determine the trade. Okay, so that's two strategies that are very, very simple, very, very effective that you can implement today. The next one I want to talk about is the imbalance. Okay, I'm not going to explain the theory behind the imbalance. That is for another video, but basically what happens is an imbalance is created with three candles. Okay, so the top of this candle here, okay, the wick of this candle and the wick of the third candle, you can see that there is a gap. Okay, and the candle in the middle, that's the candle that creates the imbalance. Okay, there's an imbalance in the market, meaning there's just a big order that's come in, a big market order that's basically knocked through the limit order book. Okay, big players come in, decided to move this market, and they've created this imbalance, which means there's going to be liquidity here, because we have a lot of limit order shorts now stuck in this range. Okay, so as you can see, when the price gets into it, it immediately moves out. Okay, we get buyers stepping in to fill the inefficiency in the market. Okay, this is called sometimes a fair value gap, but I like to keep it pretty simple. This for me is an imbalance in the market. I like to look at imbalances in the market when I'm trading, through the order flow especially. But this, completely beginner friendly. Okay, you see this gap, all right, you see that gap. If you see this gap between these two, that is an imbalance. The market has a tendency to come back and fill that imbalance. There is a theory behind it, but I'm not going to explain it for the purposes of this video. Okay, but the point is, when we get into that gap, you can start looking to place some longs as soon as you see some movement out of it. Okay, I'll give you an example of this, a trade that we've taken. So we have price moving down, we create this imbalance. As we talked about, this is obviously to the downside. The imbalance came to the downside. So between this wick and this wick, we have this imbalance between this candle. Okay, so now we have an imbalance. I come back down, the market starts trading into that imbalance. Okay, and we get a massive rejection. But the reason why I would have taken this trade on the first attempt is because of this volume. Okay, I would not be looking to take it on bullish volume like this, even though we did get a rejection. What I want to see is low volume as we get in to the level. For me, that is more prime for a higher probability trade. Even though we got movement back down, I wouldn't have taken this one. But as you can see, when we reapproach the fair value gap or imbalance, whatever you want to call it, you can see the volume is just completely diminished. Okay, so as you can see, low volume in this candle, we get the breakdown. Okay, the second candle, bearish candle, would be my entry. Stop loss above these equal highs here. and we're taking the market back down towards the lows of the range. Okay, very, very simple, very, very effective. Again, this is an imbalance strategy, very, very simple strategy that you can use starting today. Go on the chart, have a look at these imbalances, look at how many times price revisits the level and see how many times it's been rejecting from those levels. Very, very high probability trades. I can promise you, you can go and have a look at any chart available on trading. Have a look at these imbalances, identify them, wait for the retracement into those imbalances. Okay, that's where the liquidity is, and then we can look to take the trade in the direction that it's trending. Okay, so those are very, very three simple strategies that I've shown you that you can implement. Keep it simple. We have not used a single indicator. Okay, there's good indicators that you can use, but the amount of lines and crazy amount of indicators that I see on people's chart is staggering. Okay, no wonder so many people fail at trading. Keep it simple, keep it minimalist. Okay, we want to keep our charts as clean as possible. You can see here we've not used a single line or indicator or anything like that. Okay, we're keeping it simple. We're keeping it based on volume and price action. That's the most important two concepts in trading. So guys, the whole point of me showing you very, very simple and effective trading strategies is so you can keep your risk very minimal. You can start building some confidence in your decision making. You can start implementing these strategies to see what is working for you and what is not. Okay, so you want to keep it as straightforward, keep it very, very neat, very simple. As a beginner, there is nothing wrong with trading small. Okay, you want to be trading with small capital, and then as you increase your confidence, as you increase your experience in the market, you can start using more advanced trading strategies that we are using with order flow. And if that's something that you want to learn, head over to the website. Okay, we have a course designed for that. But my point is, as a beginner, you want to get familiar with the market. You want to be very, very comfortable with the market. Okay, and you want to build confidence. You want to build a game plan so you can have long-term success. Okay, if you have enjoyed this video, please hit the like, hit the subscribe button for more future beginner-friendly content like this. Okay, I would love to have your thoughts on this video. Leave some comments in the comment section. Happy trading. Stay safe out there. Peace.